Incomplete portfolio, period 15, 2014 to present, 18.3% alpha to the Sensex, 26.4% absolute returns till date. All cap portfolio stocks ITC, Asian Paints, Godrej Consumer, Marico, IPCA, Berger Paints, Page Industries, Balakrishna Industries, East Rex, E-Clerk Services, Mayur Uniquoters, V-Guard Industries, HCL Tech, HDFC Bank, Axis Bank, City Union Bank, and Group Finance. Large cap portfolio stocks ITC, Asian Paints, Godrej Consumer, Marico, HCL Tech, HDFC Bank, and Axis Bank. The returns shown in the table below denote the performance of the portfolio since 1st July to 2014. This coffee can portfolio outperformed the Sensex by a handsome margin of 18.3% over this period. Exhibit 132, summary of the 15th iteration. The strong performance was led by V-Guard, which generated a CAGR return of 61% during this period. Exhibit 133, portfolio performance of CCP 2014. Exhibit 134, V-Guard Industries was the best performer of CCP 2014. Incomplete portfolio period 16, 2015 to present, 11.2% alpha to the Sensex, 17.7% absolute returns to date. All cap portfolio stocks ITC, HCL, Tech, Lupin, Asian Paints, Cadila, Britannia, Marico, GSK Consumer, Colgate, Amar Raja, Page Industries, Berger Paints, E-Clerk Services, Astral, V-Guard, Sarah Sanitaryware, HDFC Bank, Axis Bank, LIC, Housing Finance, Group Finance. Large cap portfolio stocks ITC, HCL, Tech, Lupin, Asian Paints, Cadila, Britannia, Marico, GSK Consumer, Colgate, HDFC Bank, Axis Bank, LIC Housing Finance. The coffee can portfolio outperformed the Sensex by a handsome margin of 11.2% over this period. Exhibit 135, summary of the 16th iteration. The all cap portfolio was able to outperform the Sensex by and large cap portfolio on the back of strong performance of V-Guard and Astral Poly, which generated CAGR of 65% and 33% respectively. Exhibit 136, portfolio performance of CCP 2015. Exhibit 137, V-Guard was the best performer of CCP 2015. Incomplete portfolio period 17, 2016 to present, 2.8% alpha to the Sensex, 18.1% absolute returns till date. All cap portfolio stocks HCL, Tech, Lupin, Asian Paints, Cadila, Britannia, Amara Page Industries, E-Clerk Services, Astral, Sierra Centivere, HDFC Bank, Axis Bank, LIC Housing Finance, Group Finance, Relaxo Footwear, Repco Home Finance, Dr. Lal Path Labs. Large cap portfolio stocks HCL, Tech, Lupin, Asian Paints, Cadila, Britannia, HDFC Bank, Axis Bank, LIC Housing Finance. The CCP beginning 2016 has just completed 1 year with both all cap and large cap CCPs beating the Sensex with an alpha of 2.8% and 7.3% respectively. Exhibit 138, summary of the 17th iteration. HDFC Bank, Group Finance, LIC Housing Finance, Astra Poly, Cadila Healthcare were the top performers in the period by giving 1 year returns of 42%, 59%, 50%, 42%, and 61% respectively, while Lupin's value dropped by 32%. Exhibit 139, portfolio performance of CCB 2016. Exhibit 140, Group Finance, LIC Housing Finance, Astral Poly, Cadila Healthcare, and HDFC Bank were the best performers of CCP 2016. Incomplete portfolio period 18 2017 to present. All cap stocks: HDFC Bank, HCL Technologies, Lupin, LIC Housing Finance, Page Industries, Group Finance, Amar Raja Batteries, Abbott India, Astral Poly, Dr. Lal Path Labs, Repco Home Finance, Muthoot Capital Services. Large cap stock: HDFC Bank, HCL Technologies, Lupin, and LIC Housing Finance. A total of 12 companies made it to the 18th coffee can portfolio. Of these, one was bank and four were NBFCs. The exhibit below shows a complete list of companies for the 2017 iteration of the CCP. Exhibit 141, Portfolio Composition of CCP 2017. Appendix 2. How punchy can the PE multiple of a great company be? A large proportion of investors and financial analysts use shortcuts to value companies. Some of these include using 5 to 10 years historical average price to earning or price to book multiples to arrive at the absolute valuation, or using price earnings to grow, that is the ratio of P divided by expected growth of stock ratio, to identify overvaluation and undervaluation relative to peers. All these methods anchor themselves either to history or to peers' performance, no matter how unjustified these comparisons might be in the future. We present a simple example of how ratios like price to earning and price to earning growth can skew the actual picture of shareholder value creation and make it look rosier than it actually is. Take two hypothetical companies X and Y, which make revenue of rupees 1 million in year 1 and have the same projected revenue growth of 5% and profit margin of 10% until year 5. However, as shown in the table below, company X needs to reinvest 50% of its earnings each year to maintain 5% growth in the revenues and earnings, while company Y needs to reinvest 25% of its earnings. Thus, in year 1, company X generates 50,000 rupees in free cash flow, while company Y generates 75,000 in free cash flows. Rupees 50,000 in free cash flow, while company Y generates 75,000 free cash flow. In both cases, those free cash flow figures grow at 5% per year, just like the earnings and revenue figures do. To value each company, then would you look at free cash flows or earnings? Exhibit 142, Comparison of two firms with similar earnings but different cash flows. The interesting thing about earnings is not only that they can be manipulated according to the whims of the management team, but they all only provide information about how much profit a business can generate every year and not about the reinvestment of those earnings necessary to keep the business running. The cash flow figures, on the other hand, describe clearly how much of the profit is actually left for shareholders. Using these free cash flow figures and plugging them in a simple DCF model with an assumption of 5% growth rate discounted at cost of capital 15% results in company X being valued at rupees 500k versus company Y at rupees 750k. An obvious answer given by the company Y requires less investment for the same earnings and so generates more free cash flows. Now let's look at the conventional methods of ascertaining value would project in this case. Assuming both companies are traded at a fair price, company X would have a PE of 5 versus company Y, which has a PE of 7.5. The PEG ratio of the company X would be 1, while company Y would be 1.5. Most investors would look at these two companies and conclude that company X is a better value than the company Y because you are paying lower PE and lower PEG ratio for the same earnings and same growth in earnings. While this assessment is not harmful as both companies are fairly valued at this price, issue arises when we change the prices. For instance, if company X was trading at 600k while company Y was trading at 650k, company X would have a PE of 6 versus 6.5 for company Y. The PEG ratio of these two companies would be 1.2 and 1.3 respectively in this scenario, concluding on the basis of PE and PEG ratio that company X was a better value than company Y would be wrong. It's actually the contrary. Company Y was able to justify higher valuations for the same level of growth and earning because of its higher marginal return on capital. As the example above clearly highlights, company Y was able to generate incremental earnings of rupees 5,000 in year 2 by investing rupees 25,000 into business as compared to company X, which had to invest rupees 50,000 to achieve the same growth. This means that marginal return on capital for company Y was 20% versus 10% for company X. Once this finding comes through, one realizes the flaw in traditional matrices of plainly using earnings as a determinant of value. Besides the need to factor in the cash generative nature of the business and the valuation methodology, the added flaw is using PEG ratio or P multiple is that these methodologies do not adequately capture the longevity of the franchise. For instance, let us assume that two companies cited in the example above had the same investment requirements and cash generation for the next 5 years. However, there is a difference in the sustainability of the two firms' competitive strengths. While X can sustain its competitive advantage for 10 years, Y can sustain its competitive advantage for 20 years. In this case, company Y deserves a significantly higher PE multiple than company X, despite delivering the same set of financials over the next 5 years. So, how punchy can the fair value of a great company be? Let us assume that the coffee can philosophy has identified a company ABC which will deliver the following financial performance: sustain an ROCE of 35% for the next 20 years from 2017 to 2037, maintain a dividend payout ratio of 30%, that is, it reinvests the balance 70% earnings in the business and generates 35% ROCE on this incremental capital employed. Let us also assume that the popular theory of mean reversion applies to its price to earning multiple after another 20 years, and hence in 2037 company ABC will trade at the market average price to earning multiple of 20 times. This is possible if in 2037 there is no visibility of another 20 years runway for growth. Now, the big question is at what multiple in 2016 will this company deliver market average returns over the next 20 years? The following points answer this question. The BSC Sensex has delivered 11.1% of CAGR over the past 25 years. So let us assume 11% CAGR to be the likely market return over the next 20 years. If the said company's price to earning multiple in 2017 is 210 times, yes, you read that right, 210, then the company will deliver 11% compounded annualized return over the 20 years, assuming a steady decline in its PE to 20 by 2037. If more realistically, ABC is always, sorry, if more realistically, ABC is available for reinvestment at 50 times the PE in 2017, then it will deliver 19.5% share price CAGR over the next 20 years, even as the company's price to earning declines from 50 times in 2017 to 20 times in 2037. The exhibit below shows the results of this exercise for a company which is expected to generate 35% of return on capital employed consistently over the next 20 years while reinvesting 70% of its operating cash flows back into the business, even if the price to earning multiple of such company is 50 times today and derates gradually to 20 times. That is close to the market average price to earning over the next 20 years. Investors buying the company's shares today will realize a healthy 19.5% CAGR in the total shareholder returns over the next 20 years. Exhibit 143, conviction on fundamentals will give healthy returns even with high entry price to earning. Appendix 3, should investors sell coffee can stocks when markets are richly valued? We consider five scenarios to analyze whether buying and holding the coffee can portfolio makes sense in India. The description and results for each scenario are given below. Scenario 1, we sell when the Nifty's trailing price to earning multiple goes above 20 times and invest in government bonds. We wait for a year before making the reinvestment decision, and such a decision is taken only if the multiple has dropped below 20 times. At that juncture, we reinvest in the fresh ongoing CCP as at that time. So, for example, when the Nifty exceeds 20 times the trailing earnings in October 2007, we sell the entire portfolio. We then wait until October 2008 and buy the CCP FY08 at that point. As can be seen below, barring a couple of portfolios with minor outperformance, none of the CCP portfolios following the scenario 1 strategy were able to beat their buy and hold counterparts. Exhibit 144, selling the coffee can portfolio when the Nifty price to earning is above 20 does not outperform buy and hold. Scenario 2, we sell when the Nifty trailing price to earning multiple goes about 20 times and invest in government bonds. We wait for multiple to drop below 14 times to reinvest in a fresh CCP at that time, equal allocation of all new stocks. So, for example, when the Nifty exceeded 20 times the trailing earning in July 2009, we sell the entire portfolio and buy government bonds. We then wait until December 2011 and buy the CCP FY11 at that point. In this scenario, while the completed CCP portfolios until the ones initiated in 2006 show marginal outperformance, the incomplete ones underperform the buy and hold CCP strategy significantly. Exhibit 145, selling at high multiples and buying at low multiples underperform buy and hold in most cases. We ran three more scenarios to test the robustness of the buy and hold strategy. Scenario 3A. In this scenario, rather than selling when valuations are rich, we stay put, and when the Nifty trailing P drops below 14 times, we exit the old CCP and enter into the fresh CCP as at that moment. The money is allocated equally to all new CCP stocks. Scenario 3B. In this scenario, rather than selling when valuations are rich, we buy more when the Nifty trading P drops below 14 times. We double the investment amount whenever this happens, and the money is allocated equally to all existing CCP stocks. Scenario 3C, as in the previous scenario, rather than selling when relations are rich, we buy more when the next trailing P drops below 14. However, we remain cognizant of the compounding benefits enjoyed by outperforming stocks in CCP so as to not penalize them by equally allocating new money. In this scenario, we double the total investment amount but allocate this amount as per the stock's existing weight. Interestingly, we find that even in these scenarios, there is no outperformance as compared to the buy and hold strategy. The findings above make sense when one realizes that the firms that do make it to the CCPs enjoy sustainable competitive advantages over their competitors, which reflects in their share price performance. Thus, trying to time the market and using market level valuations as a guide to especially make sell decisions proved to be counterproductive as companies with sound fundamentals and excellent return ratios will continually look to be expensive. Appendix 4, how coffee can portfolios outperform during market stress. Only when the tide goes out do you discover who's been swimming naked. This insight from Warren Buffett has repeatedly proved correct when it comes to investing in stocks. When the broader market is undergoing an euphoric or bullish phase, most stocks do well regardless of the quality of the underlying fundamentals. However, when the euphoria ends, stocks with poor underlying fundamentals are decimated, leading to significant capital erosion for investors who did not adequately understand the weak fundamentals of their portfolio companies. As shown in the exhibit below, during periods of market stress, encircled in the exhibit below, the performance trajectory of the coffee can portfolios CCPs consistently generate the following outcomes. The CCPs tend to fall less than the overall stock market. The recovery following the crash is faster and stronger for CCPs compared to that of the broader market. Exhibit 146, Coffee Can Portfolio CCP versus Sensex 1 year holding period using total shareholder returns. The only period when coffee can portfolios underperformed compared to the broader market for more than a year was from May 2005 to August 2007. This was a period of irrational exuberance in cyclical sectors like infrastructure, real estate, and utilities. However, it is worth noting that despite this relative underperformance during the broader market's euphoric phase, the CCPs continued to generate healthy absolute returns of 20% to 25%. Understanding CCP's resilience via histogram of annual share price returns. Let us begin by putting the Sensex annual return for the last 25 financial years on a histogram. See Exhibit 147. As the histogram shows, 10 of the last 25 years, that is 40% of the instances, have seen a negative return from Sensex, with the remaining 15 years, that is 60% of the instances, having delivered a positive return. Exhibit 147, Sensex histogram of annual return, positive return in 60% of the instances. Next, we replicate these 25 years histogram for some of the stocks that have frequently formed part of our coffee can portfolio. In these stock specific histogram, we have shaded the years in which the direction of the stock price movement was reverse of the direction of Sensex, that is, years when the Sensex delivered negative returns and the stock still delivered a positive return, and vice versa. There are two key conclusions from these stock specific histograms. Exhibit 148 to 155. Conclusion number 1. Most of the stock specific histogram of CCP companies are skewed to right, that is, while 60% of the instances show a positive return for Sensex, the corresponding number of CCP companies is more like 80% to 90%. Conclusion number 2. There have been several years in which the stock gave a positive return, while in 10 out of last 25 years, the Sensex gave a negative return. The number of such instances is anywhere between 3 and 6 out of 10 years of Sensex negative returns in each of the histograms shown below. Exhibit 148, Marico's histogram of annual share price returns. Exhibit 149, Berger Paints histogram of annual share price returns. Exhibit 150, Asian Paints histogram of annual share price returns. Exhibit 151, Britannia's histogram of annual share price returns. Exhibit 152, Amar Raja's histogram of annual share price returns. Exhibit 153, Relaxo's histogram of annual share price returns. Exhibit 154, HDFC Bank's histogram of annual share price returns. Exhibit 155, Guru Finance's histogram of annual share price returns. So, why does the coffee can philosophy outperform the broader market even during the periods of market stress? As highlighted in Chapter 2, the coffee can philosophy seeks firms which can deliver healthy and consistent revenue growth and return on capital employed over long periods of time. This implies that even when the broader macroeconomic environment or the competitive landscape becomes difficult for a CCP company, the firm is able to deliver healthy revenue growth and ROCE. These characteristics ensure that during the prolonged period of stock market stress, CCP companies would more often than not deliver positive returns due to one of the following two factors. First, earnings growth more than offsets the price to earning derating during periods of stock market stress. Stressed periods of the stock market usually occur due to deterioration in earnings growth prospects of the constituent stocks compared to what are already factored into the share prices. Since the CCP companies can maintain healthy growth even in the disruptive external environment, the ripple effect of a stressed stock market price to earning multiple derating tends to be more than offset by CCP company earning growth delivered during the same period. As a result, the share price of such a company could end up giving positive returns even during periods of stress in the broader stock market. The table below highlights some of these instances for firms like Asian Paints, Amar Raja, and ITC. Example of CCP stock earnings offsetting PE de-rating during periods of stress in broader stock market using trailing 12-month EPS and price to earning multiples. Number two, price to earning does not derate because the market incrementally factors in longevity of earnings. As CCP stocks tend to deliver consistent revenue and earning growth during periods of weakness in fundamentals for the broader market, it is likely that the price to earning multiples of CCP companies start factoring in a greater degree of sustainability of earnings growth over the longer term and future. For example, in FY12, Asian Paints delivered a 28% share price growth, while the Sensex declined by 10%. During this period, Sensex earning grew by 6% and its trailing price to earning multiple declined by 16%. However, despite this market-wide derating in the price to earning multiple, Asian Paints price to earning multiple increased by 10% and its EPS grew by 17% in FY12.